Every day, millions of people buy stocks, the same way they buy lottery tickets. They see a number on a screen, the price goes up. They feel excited, they buy it. They see a number go down. They feel panic, they sell it. They are not investing, they are guessing. And the worst part is, they do not even know. They are guessing. They think they are being strategic. They think watching the price move up and down and reacting to it is some form of intelligent participation in the financial markets. It is not. It is the most expensive form of entertainment ever invented, and the reason they are guessing is because nobody ever taught them the one question that every serious investor must answer before touching a single dollar. What is this thing actually worth? Not what is the price today, not what does the chart look like, not what is everyone on the internet saying about it. What is it actually worth? That question has a name in the world of investing, and that name is intrinsic value. Today, I'm going to explain intrinsic value so simply and so completely that by the end of this video, you will immediately understand something that most people who have been buying and selling stocks for years still cannot articulate clearly, and that gap in understanding is costing them enormous amounts of money every single year. Let me tell you why I started thinking about this when I arrived on Wall Street. As a young man in the 1920s, I was genuinely shocked by what I saw. Grown men, educated men in expensive suits, were buying and selling shares of companies based almost entirely on what other people were doing. They watched the ticker, they watched the crowd, they watched the price, and they made their decisions accordingly. The actual businesses behind those stock certificates, the real companies with real employees and real products and real revenues, were almost entirely irrelevant to the conversation. Nobody was asking, what are these businesses actually worth? They were only asking, what will someone else pay for this? Tomorrow, I remember sitting at my desk looking at the financial statements of a company whose stock was trading at a very high price and calculating that the business itself, based on what it actually earned and what it actually owned, was worth a fraction of what people were paying for it. And I thought, this cannot last. It did not last. In 1929, the entire edifice collapsed, and the people who had paid any price for any stock, because prices were going up, lost fortunes that some of them never recovered. I did not lose everything in 1929. And the reason I did not lose everything is because I had a framework for understanding what things were actually worth independent of what the crowd was willing to pay for them. That framework is intrinsic value, and it is the most important concept I ever developed. The fruit tree nobody wants to talk about. I want you to forget stocks completely. For a moment, imagine your neighbor comes to you and says he wants to sell you a fruit tree. Growing in his backyard, this tree has been producing fruit reliably for 15 years every single year, without fail, rain or shine. Good economy, bad economy. It does not matter that tree produces $500 worth of fruit per year. It needs almost no maintenance. It just grows and produces and produces and produces. Your neighbor wants $1,000 for the tree. Is that a good deal? Think about it. For a moment, you pay $1,000. You collect $500 in fruit every year. And in 2 years, you have your money back. And every single year after that is pure profit for as long as that tree keeps producing. That tree has a very clear intrinsic value based entirely on what it actually produces, not on what someone says it is worth, not on what the market for fruit trees is doing this week, but on the cold, simple mathematical reality of what it generates for its owner. Now I want you to imagine a very different scenario. A different neighbor comes to you with a different tree. This tree has never produced a single piece of fruit, not one orange, not one apple. Nothing, but your neighbor is very excited about it. He tells you everyone in the neighborhood is talking about this tree. He tells you the price has been going up every week. He tells you that people much smarter than both of you have said this tree is going to be the most productive tree anyone has ever seen. And if you do not buy it right now, today, you are going to miss the opportunity of a lifetime. He wants $5,000 for a tree that has never produced anything. Most people in that situation would walk away immediately, because when it is a tree, and it is a physical object, you can see the absence of fruit, you can see the emptiness with your own eyes. Your common sense protects you, but put that same logic inside a stock ticker, and suddenly the common sense disappears. The excitement of the crowd overwhelms the simple question, and people pay $5,000 for trees that have never grown a single piece of fruit. This is the entire difference between intrinsic value and market price, and it is the entire difference between investing and speculating. What intrinsic value actually means, in plain language, intrinsic value is what something is genuinely worth based on what it actually produces, not what people are excited about today, not what the chart looks like, not how many times it has been mentioned on social media this week. What does it actually produce, and how much is that production worth to a rational owner who plans to hold it for a long time? When you buy a share of stock, you are not buying a number on a screen. You are buying a small piece of ownership in a real business. That business has real employees, real products, real customers, real revenues, and real profits or real losses. And the value of your ownership stake is determined entirely by what that business produces for its owners over time. Everything else is noise. The daily price movement is noise. The analyst upgrades and downgrades are noise. The excited headlines are noise. The fearful headlines are noise. The only signal that matters is, what does this business actually earn? And is the price I am being asked to pay reasonable given those earnings? That is it. That is the whole game simplified to its essential truth. The coffee shop on your street. Let me give you an example even closer to everyday life than the fruit tree. Imagine there is a coffee shop on your street. You walk past it every morning. You notice it is always busy. You know the owner a little, and one day he tells you he is thinking about selling the business. You ask him how much profit the shop makes after paying rent, staff supplies, and all other costs. He tells you the shop clears $40,000 per year in real profit consistently. It has done this for 7 years. You now have the most important number. You need to start thinking about intrinsic value. Now the question is, what is a reasonable price to pay for a business that earns $40,000 per year? Reliably, if you paid $400,000 for that coffee shop, you would be paying 10 times. The annual earnings, economists and investors call this a price-to-earnings ratio of 10. And for a stable, reliable small business, that is a fairly reasonable price. You would recoup your investment in roughly 10 years. And then every year after that is profit. If the owner asked you for $800,000, he is asking you to pay 20 times earnings. Now the question becomes much harder. Is this business growing fast enough? And is it reliable enough to justify paying that much more? Would you recoup your investment before the world changes and coffee culture shifts, or rents increase, or competition arrives? And if the owner came to you and said, "I want $2 million for my coffee shop, that earns $40,000 per year. He is asking you to pay 50 times earnings. At that point, you have to ask yourself very seriously, what story am I paying for? Because the math of that business as it currently exists does not come close to justifying that price. This exact same logic applies to every stock you will ever consider buying. The price-to-earnings ratio is simply the market's version of asking how many years of current profit are you willing to pay up front. When that number is reasonable, you may have found an intelligent investment. When that number is extreme, you are no longer buying a business. You are buying a story. And stories do not always have happy endings. The 3 questions every beginner must ask now. Let me make this as practical as possible because understanding the concept is one thing, but actually using it is another. Before you buy any stock, I want you to answer 3 questions, and these 3 questions alone will put you miles ahead of the average retail investor. Question number 1, how much money does this business actually make? Not the revenue. The revenue is the total amount of money that comes in through the door. That number sounds impressive, but it means almost nothing by itself. What matters is how much is left after paying everyone and everything. The profit, the real cash that belongs to the owners, is the number you need, and for any publicly traded company, this number is public information. You can find it in 30 seconds. Question number 2. How reliable and consistent is that profit? This is the question most beginners completely skip, and it is the one that matters enormously. A business that has made steady growing profits for 15 consecutive years is worth dramatically more than a business that had one spectacular year and nothing before that. When you buy a business, you are not just buying last year, you are buying all the future years, and a long track record of consistency tells you something very important about what those future years are likely to look like. Question number 3, what am I actually paying relative to those earnings? Take the current stock price and divide it by the annual earnings per share. That gives you the price to earnings ratio, and that ratio tells you how expensive or how cheap the market is pricing this business relative to what it actually produces. A ratio of 10 or 15 for a stable business often represents reasonable value. A ratio of 30, 40, or 50 demands a very compelling explanation about future growth, and even then deserves extreme caution. A ratio of 100 or more means you are almost entirely paying for a story about the future, and the future has an unbroken track record of surprising people. These 3 questions will not give you a perfect number. Intrinsic value is always a range. It is always an estimate. And anyone who claims to calculate it with mathematical precision is deceiving you, or deceiving themselves. What they give you is something far more valuable than false precision. They give you a rational anchor, so that when the market offers you a price, you can look at that price with clarity and judgment, instead of reacting with pure emotion. The gap that creates every opportunity in investing here is where intrinsic value transforms from an interesting concept into a practical weapon. The market price of a stock and the intrinsic value of the underlying business are almost never the same number. Sometimes the market gets euphoric, it gets excited, it extrapolates recent good news into an infinite future of success, and it prices businesses at 2 or 3 times what they are rationally worth. Sometimes the market gets terrified. It looks at temporary bad news and convinces itself that a good business is permanently broken, and it prices that business at half or a third of what it is genuinely worth. These mispricings happen constantly. They happen in bull markets, and bear markets, in recessions and booms. And the gap between market price and intrinsic value is where every single opportunity in intelligent investing actually lives. When the market prices a solid business at $70 per share, and your honest, careful analysis suggests the intrinsic value is $100, you have found something worth investigating further. The market is temporarily wrong, and patient investors who buy at that gap and hold, while the world gradually recognizes the true value, are the ones who build real wealth over time. When the market prices a business at $150 per share, and your honest analysis suggests the intrinsic value is $100, you have found a warning sign the market is pricing in a future that may never arrive. And if you buy at that price, you are entirely dependent on finding someone even more optimistic than you to buy it from you later at an even higher price. My student Warren Buffett once described this situation perfectly. He said in the short run, the market is a voting machine, but in the long run, it is a weighing machine. In the short run, prices reflect popularity. They reflect excitement. They reflect what the crowd feels like paying today. In the long run, prices migrate toward value. They always have. They always will. Because the underlying business is either producing real profits for its owners, or it is not, and reality is patient. It will wait as long as necessary. But it always, eventually, arrives. Why this matters more in 2026 than at any point in history. Right now, in 2026, you have access to more financial information than any investor in the history of markets. You can pull up the complete financial history of any publicly traded company in 30 seconds on your phone. You can read earnings reports. You can find analyst breakdowns. You can access revenue histories, profit margins, competitive analyses, and management commentary, all completely free, all immediately available, and yet the average retail investor ignores all of it. They look at the price, they look at the chart, they scroll through comments under a social media post, and they make a decision that involves real money, that took real work to earn. The reason this happens is not stupidity. It is the absence of a framework. When you do not have a framework for what something is worth, the price becomes your only reference point, and the price is completely useless as a reference point without context. A stock trading at $500 might be extraordinarily cheap. A stock trading at $3 might be catastrophically expensive. But without understanding intrinsic value, you cannot tell the difference. Intrinsic value gives you the framework it gives you, the lens that transforms a confusing screen full of flickering numbers into a simple, answerable question. Is what I am being asked to pay more or less than what this actually produces for its owners? That question, practiced consistently and honestly, is more powerful than any trading algorithm, any technical chart pattern, or any hot tip from any source on the internet. The mistake that destroys most beginners. I want to spend a moment on the single most common mistake I have watched investors make across my entire career, because it flows directly from not understanding intrinsic value. The mistake is paying for a story instead of paying for a business. Stories are seductive. I understand why people fall for them. A compelling narrative about a technology that will change everything, or a company that is growing at breathtaking speed, or an industry that is on the edge of a revolution, can make almost any price feel justified. But here is the brutal truth about stories. The future almost never arrives exactly as the story described it. Companies that were going to dominate their industries face unexpected competition. Technologies that were going to change everything take 3 times as long as expected to be adopted, growth rates that seemed unstoppable, hit walls that nobody predicted when you pay a fair price for a business based on what it actually earns today, and the story does not come true. You lose a little because you were protected by the current earnings when you pay 50 or 100 times earnings for a story and the story does not come true. You lose everything because there was nothing underneath the story to catch your fall. Intrinsic value-based investing is simply the discipline of refusing to pay for stories you cannot verify and insisting on paying for production you can see, measure, and evaluate. It sounds conservative. It is conservative. But the investors who practiced this discipline through every market cycle of the past century quietly built fortunes, while the story chasers spectacularly destroyed themselves and periodically rebuilt and destroyed themselves. Again, your assignment here is what I want you to do this week before you make any investment decision at all. Pick one company you already own, or one company you are thinking about buying. Go find its earnings per share from the last full year, and from each of the 5 years before that. You are looking at 2 things: the size of the earnings and the consistency of the earnings. Now look at the current stock price and divide it by last year's earnings. That is your price to earnings ratio. Write that number down. Then ask yourself honestly, does this number make sense given what this business reliably produces? Is this a fruit tree I am paying a fair price for? Or is this a tree that has never grown fruit and I am paying $5,000 because everyone around me seems excited? You do not need a spreadsheet. You do not need a finance degree. You need 15 minutes and the willingness to ask the question that 90% of retail investors skip entirely. What is this business actually worth? Ask that question every single time, without exception, and you will have separated yourself from the crowd in the most important way possible. You will be thinking like an owner, not like a gambler. The bottom line, intrinsic value, is simply what something is genuinely worth, based on what it produces for its owners. The market price is what someone is willing to pay for it at this particular moment, driven by this particular combination of excitement, fear, greed, and noise. These 2 numbers are almost never the same, and the gap between them in both directions is where the intelligent investor lives when the price is significantly below the intrinsic value you buy, and you wait when the price is significantly above the intrinsic value. You do nothing and you wait. And when the price is roughly equal to the intrinsic value, you think very carefully about whether the quality of the business justifies holding it at full price. That is the entire discipline. There is nothing more complicated than this. Find what something is worth, pay less than that, and have the patience to let reality close the gap. Every great investor who ever built lasting wealth across every era and every market cycle practiced some version of this principle, and every speculator who ever destroyed themselves was doing the opposite, paying prices they could not rationally justify, and hoping someone else would be even less rational tomorrow. You get to choose which of those 2 people you are going to be. Choose the fruit tree, with the consistent harvest that is intrinsic value. Explained simply, that is how the intelligent investor thinks. Thank you.